So Lemonade is releasing their Q4 results on Tuesday, February 27th after the market close. In this video, I want to break down my model, what I'm forecasting for Q4 and 2024, and just kind of discuss everything you might need to know or think about for these exciting Q4 results that are coming up. I can't remember if there's been a quarterly results that I've been more excited for. So without further ado, let's dive into it. So Lemonade guided at the end of Q3 for Q4 that they would have at the high end, the better end, $729 of in-force premium, $729 million in-force premium, and adjusted EBITDA loss of minus $42 million. So keep those figures in mind: $729 million IFP, $42 million in adjusted EBITDA loss. And just to sort of lay out where we might be headed and a few possible outcomes. Here in my Lemonade model, just sort of on a side tab, I've laid out, hey, here's a bear case, a more base case, and a couple more bullish cases on where's customer count, where's premium per customer, where's in-force premium going to end up, gross loss ratio, what's that, operating expenses as a percentage of gross earned premium, so where's that percentage at, and adjusted EBITDA. Then the outputs of that, what's your adjusted EBITDA, what's your earnings per share. Adjusted EBITDA, there's some more assumptions you have to make that I'm not showing here, but at least within my model, how it's currently set up, you'll see sort of a variance or a few possible outcomes. So let's look at a first one here, the bear case, at least what I'm calling bear case, which is maybe kind of funny and ironic, but you'll see here right away. I'll pull up the black. So we have 2 million customers, 2.01 million customers, $362 premium per customer, 2.01. I think that's very reasonable because we know, I think it was in November, around then when they reached 2 million customers, so adding about another 10,000 through the remainder of the year. And 362 was what they did in Q3 for premium per customer, so it assumes no premium growth. You multiply those together, you get 728 million in IFP. Does that sound familiar? It's kind of funny because that's right in the range of what they're forecasting for they're guiding for their in-force premium, which is kind of funny because I'm calling that the bear case, which is sort of why I'm laughing. But we do know that Lemonade management does have a history of very conservatively guiding and then beating that guidance. So that's why I'm saying, hey, if they just sort of meet guidance, it's really not that great. That's more of a bearish case. Gross loss ratio, I'm putting, let's say that's 80%. Operating expenses as a function of gross earned premium is 55%. And you might be wondering, hey, is that a reasonable number? That's a very reasonable number, 55%. If we go back to last quarter, we were at 57%. 57% also included a $6.7 million one-time expense related to Metro Mile. So if you subtract out of those total expenses $6.7 million, actually last quarter we were at about 53% total expenses relative to gross earned premium. But anyways, I will undo that and pop that back in. So we were at 57, but saying, 55 is even technically worse than we were last quarter. So in this bearish case, and then your outputs, adjusted EBITDA, earnings per share, see what the results are. You get about 40.5 million adjusted EBITDA loss, which is still beating what they're guiding for an adjusted EBITDA loss. So that's why, again, why it's kind of funny. Hey, even if there's just a slight beat on guidance, I still think that's really not that great. And earnings per share of about 80 cents per share. So now let's move to the base case. So base case, what do we have for inputs here? We have same customer count, slightly better premium per customer, so you get a little bit better IFP. Gross loss ratio coming down a little bit, 70%. Operating expenses coming down a little bit, 52%. And your results, again, for that, pop in at minus 34 million adjusted EBITDA. So a decent beat then in this sort of base case, and 71 cents earning per share. That to me, it's like they should at least do this good. Like 77% gross loss ratio should at least do that good. This is kind of, where customers you think could easily come in at this value. And then premium per customer is just a little bit of premium per customer growth. And now bull case 1 is sort of where I'm thinking they might actually be. And I'm going to be spending a lot of time in this video after we get through this table breaking down why these figures, in my mind, kind of make sense. And are more likely or more probable than maybe even these bear or base case. So let's pop these ones in there. So it's a little bit more customer growth, 2.021, so about 10,000 more customers. $371, so you get the same premium per customer. $371 gets to $750 million IFP. So pretty significant beat from what they're guiding, $729. Beating that by $21 million in IFP certainly seems possible to me, though. And then gross loss ratio, I have at 74%. I really think there's a good chance they hit that kind of mid 70 range. And then operating expenses, 52%, and your output here, if we plug those in, it's a minus $31 million adjusted EBITDA loss, minus 66 cents per share. And I think current analysts are saying I think it's about 79 cents earning per share the last time I saw it, what they're predicting. And so it's a pretty solid beat on what I think the analysts are predicting, and obviously pretty solid beat on what they are guiding for in their adjusted EBITDA of minus 42 to minus 31 would be pretty solid, significant quarter. And in my mind, I think this is, again, pretty likely, at least not financial advice, but I'll be breaking down all the reasoning why I think this is possible. And then bull case 2, let's pop those numbers in. So same customer count, but even more premium per customer, and 766 million IFP, 74% loss ratio, 50% operating expenses, and you get down all the way down to, pull the right one there, into the less than 30, minus 28 million adjusted EBITDA loss, 62 cents earnings per share loss. So that would be a monster beat. I don't think that's even impossible, but that would be fantastic. First off, let's talk about their gross loss ratio. What might the gross loss ratio come in at? I have it 74% for Q4, and then 75% through the remainder of 2024. Obviously, there could be some catastrophic events within some of these quarters. It could bounce it around, might even do better than these in some of these quarters. But that's what I have right now. 74%. How do we kind of arrive at that number or think of that number? So a couple things to think about. First of all, if you look at Tim Bixby, I had this exchange with him back and forth here on Twitter, going back in, I guess this was in early January, trying to understand this paragraph from their Q3 letter where they talked about, hey, they've earned in $45 million from new rates, from increasing their prices, and those price increases being approved. $45 million in premium has been earned in, and then he says another $120 million online, but yet to earn in, and then further rates await regulatory approval. During 2024, we expect to earn an additional $100 million or more from increased rates. And then he really gave perfect clarity on this. He said, with reference to the above, the $100 million and the $120 million, the same metrics, same sort of pool of funds that are earning in, but they're referring to two slightly different time periods. First is calendar 2024, so the 100 million plus, and then the second refers to the period from September 30th, 2024 forward, so 120 million. So you can kind of read into that and say, hey, they're probably going to earn in around 20 million in Q4 in just additional premium that comes in just from increasing prices, and then additional about 25 million per quarter over the course of 2024. If you do the math, last quarter we had an 83% gross loss ratio. If you do the rough math, just say in a pool of customers, like a premium that grows from 718 to 738, purely from these 20 million being added in, multiply that by your 83%, you get about 80.7, so 81%. So it gets about a 2 and a bit percent increase in sort of positive increase in your gross loss ratio, simply from, hey, the prices are increasing a little bit, and that's earning into our books. Certain customers are turning over, are renewing at those higher rates. And of course, that trend carries forward into the next year with 25 million each quarter, but gives you an idea of, hey, you a couple percentage points increase improvement right there. Then the other thing to think about is, say, hey, actually from their Q3 letter, and this was something they tweeted out earlier this month, said, could their Q4 loss ratio be less than 75%? Hey, it was in Q3, excluding CAT, they had this figure that it was 73%. And then other insurers have reported CAT effects in the 0 to 3% range that have given their results already for Q4. So this plus that rate hike of $20 million, it seems very possible because maybe that 73%, excluding CAT, maybe it drops a couple percentage points to 71%. And then maybe you add in 3% back to that from catastrophic events, and maybe you're at 74. That's my thinking. That's how I arrived at 74%. If you look at a couple of the results here from Travelers and Allstate, Travelers had a catastrophic events for homeowners at 3.5%, and then automobile at 0.5%. in Q4. This is versus, a year prior, they were at 18% was attributed to catastrophic events. So major improvement, super good quarter for catastrophic losses. And then if you flip over, again, this is by Riley E645, his tweet. So give him a follow on Twitter if you haven't already. He has really great Lemonade stuff. And in Allstate, again, had catastrophic events at 0.7%. So really low CAT events, and this is also in line with other insurers that had very positive loss ratios, very minimal type of catastrophic events. So you kind of think that 73%, you're improving that maybe by a couple percent to 71% just from the rate increases of 20 million, and then you add, it could even be it could be as low as 71%. They could have a loss ratio of 71, and maybe my 74 could be kind of a little bit too high, but I'm putting 74 that there's a little bit of loss, a little bit of catastrophic events on top of, however they define that, from top of the 73. So 74% bounce over to my model again is right there. Again, if you want to support the channel, join my Patreon. You can play with this, make a copy, and play with this whole model yourself. Now let's talk about where their total customers could end up at the end of Q4. I have 2.021 million customers, or 36,500 increase. This is kind of based on when this was November 7th. I tweeted this out. They reached 2 million customers and did a bit of rough math saying, hey, they added about 417 customers per day so far in Q4. I kind of did some math to say how much premium they could end up at if they just kept adding customers at that same amount. I did find out after that hey, they actually reached that 3 days prior. So that was more like 450 customers a day is the rate they were adding customers. And also a third of the customers, or a third of the quarter, say they would typically grow slower just because Christmas season is a much more competitive ad market, so they don't want to spend as much in that ad market. So I assume 300 customers for a third of the quarter versus 450 customers per day for 2/3 of the quarter. So just a little bit slower growth rate, and it gets you about 36,500 customers roughly. So I've kind of modeled that amount of growth gets you to that 2.021 million customers. So now we're going to talk about in-force premium forecasting. There's really only 4 things that are affecting our in-force premium, how it is changing over time. So those 4 things are churn, what amount of the customer base is churning away in any quarter, and then rate increases, which is, hey, how much is just the rates increasing, the price increases, how much is that hitting our IFP in any given quarter, and then new customer growth, which is coming, customers coming in the door, how much premium are they bringing in per customer, which could be different than the premium per customer we know or that is released for the entire book of business. It's not something we really can be sure of. And then bundling, which is just how much the entire customer base is bundling and adding to their overall premium. What's that sort of increase rate? So if we think about those 4 things, close this, and I actually have an equation here that I'm going to walk through. So we have 718 million, which was our Q3 in-force premium, and I'm multiplying 718 million, so that base amount, which we had in Q3 here, times by the amount of churn, which is 1 minus our churn rate, 18% roughly right now, to the power of 1 quarter, because 18% is on an annual basis. So you multiply that by 718, that'll give you sort of, hey, the amount of premium that's left over after the customer's churn. And then I'm adding in 20 million for the just from rate increases, which we know from that tweet by Tim on Twitter that I reviewed earlier. And then I'm suggesting from new customer growth, hey, they're going to spend $13 million in customer acquisition spend and average out, say, $110 per customer that they acquire. And those numbers come from, they're in my model right here. I'm saying $110 of customer acquisition and $13 million of customer spend. That gets you the amount of customers they're gaining back. And then I'm saying, hey, maybe they're gaining these new customers at a lower premium per customer. So I'm suggesting $275 per customer. And you'll see why I suggest that number in a moment. I'm actually show you a little bit of math behind that in a moment. And then I'm taking that whole group of customers and saying, hey, that whole group of customers is kind of naturally having a bundling effect, and say that's growing the whole overall premium or even premium per customer of the whole group by 2%. So that's why this final factor of 1 plus 0.02%. That gets you to $750 million in in-force premium. So that's sort of my rough, guess or estimate, best guess estimate and calculation for where Q4 premium might come in at. But you might be wondering, okay, well, how do you come up with this $275 of premium per customer for new customers? Where do we get that figure from, or how can we know that's a good estimation? And then also this growth number of 2%, how do we know, or where does that come from? Is that realistic at all? So flipping back to my model, I have kind of figured that out. If I go all the way down, remember, if you want to dig through this model yourself, feel free to join my Patreon. But if I go all the way down the bottom, in the lines 100 and something here, some sort of side math I've been doing. So some of this highlighted little section here from Lemonade's Q2 2022 letter. So going back a while ago, they had a paragraph about upsells, percentage of sales that were upsell or cross sells without car. And we're showing how, hey, that number was increasing from 17 to 21%. And even they said with car in Illinois in that quarter, I believe it was 36%. And overall, though, from those numbers and based on the other data points we have for those quarters, we can figure out the premium per customer increase from cross sells or quarter over quarter, as a quarter over quarter change across those quarters. And it was about 2.5%, 1.6, 1.9, or 1.88, 1.84. If this was 36%, with car, because you have to include car, then it's over 3%. So it's in that range. What I did is these values down here, I said, hey, we have this equation here, that calculates all this. If we knew a given this value, say it was 2%, for example, from these rough sort of values we got in Q2 2022, showing it's about 2%, maybe even 3% or north of that, if there's car really growing inside of those channels. If we know all that, then we can take that and calculate. What this value would be on a historical basis. So that's what I did. So say, for example, you look at, let's look at Q3 2023. I calculated, here's sort of an example of the calculation if you want to have a quick look at it. Hey, the premium we ended up with, the premium we ended up with, the premium we started with, how much customer churn we had, how much roughly due to rate increases value we added, how much did we spend, how much did in marketing CAC, how much did we spend to gain each customer, what was that premium per customer, what is that variable, and what was the bundling rate, which we don't know exactly, but we can estimate, say it was 2%. So do all that, you get math comes out to, for 2% in Q3, it was those new customers were coming on board at $227 per customer. So we flip back to my model, 2% right there, there's the math for it, $227 per customer. The result for it, I should say, is right there. If there was less bundling, say that natural bundling rate was 1.75%, then you're at 238. So it's a little bit higher, meaning you're bringing in more customers to balance out to that, end result premium that you ended up with. If your bundling rate was higher, say 2.5% or 3% even, then your premiums coming in the door were actually less. And then I historically went back. This year we can estimate, because they said 45 million in a rate increase premium for across the quarter, so we can kind of calculate that as a that 15 value. But then in previous years I estimated that value to be 0. Of course, there was some rate increases across here. We don't know all the details of that, so it's hard to estimate that exactly, but it gives you some idea that, hey, in recent years, which makes sense, management at one point said they're going to sort of more push into their most profitable lines of business, renters and pet, really focus on that, really channel those. So they've had lower premium per customer in these quarters coming in the door. And if you go back to previous quarters, it was much higher, especially if you look at the Metro Mile acquisition quarter, where their premium per customer Q3 2022 shot up 18% from 290 to 343. It really makes sense then that, hey, a lot of those new customers that they were onboarding were over $1,000 in premium per customer, which makes sense because a lot of them would have been Metro Mile customers that were car customers. Then going back, it was 390, 400 range. And if you go further back, we only have so much data we can really pull from. But you're in that lower 200 range. Just makes sense because a lot more of those early customers were probably really low-paying renters customers only, and the occasional maybe homeowner customer. So I think this data is making sense. And then what I'm suggesting is, hey, for this in-force premium calculation going into the future, for Q4, I'm using, in my data, I'm saying, hey, let's go with the 2% value, and then let's look at the last several quarters. What at the 2% bundling rate, what was the new customer premium per customer? And they have an average of about $271. And if you add another quarter in there, then we're at 297. So in that range, I decided to say, hey, for my equation here, I'm going to say 275 is what's coming in the door, and 2% bundling rate. And it gets you to that 750. So if all this analysis is making sense, maybe there's something I'm missing here, but it seems likely that, Q4 premiums could come in around the 750 IFP mark, which would be really, really solid top-line growth. But now let's talk about where could IFP go for 2024. You can see the values right here, but I'll quickly break down what the math could be. I did the same procedure once again, but moving forward into the next few quarters. So for Q1, I said 750. You're starting with 18% churn, 25 million from rate increases. You're doing some math based on the number of customers where you sort of estimated at the start. And I'm assuming a little bit higher cost per customer, but also getting a little bit more premium per customer at a same, of new customers coming in the door, 325, because I'm saying maybe they have a little bit better mix of car customers, home customers coming in the door, and again, at a 2% bundling growth rate. And at 325, again, you could kind of flip back to some of this bottom of the table math here. Is that reasonable? I think it's reasonable, because then if you look at this 2% line, and maybe we pull over the last few years of data, and say maybe every single line except for the Metro Mile line, well, then the average is 339. So the average premium per customer that's been coming in the door at the 2%, if we're thinking about the whole sort of natural bundling effect of the whole policy or group, then your average is somewhere in that 339, 340 range. So being a little bit conservative, I just rounded that down a little bit, 325. So that gets you to, just over 900 million IFP in Q1. And then you do the same procedure once again, but 901, same values, but a lot more growth spend, same sort of amount of customer acquisition cost. I lowered it from 325 to 300 because in Q3, because this is the Q3 value we're looking at, they do tend to get more renters customers, I think, typically. So a little bit lower, and then 2% growth again, that gets to 1,005. Same procedure again, finally, in Q4 of this year. back to the 325 number, a little bit less growth, customer acquisition spend, but still a lot to get to that 2.7 million customer mark. Gets you to 1,081, 1,082 IFP range. So that's what I have right there shown in my model then, 1,082 IFP range, which does represent a 44% year-over-year growth metric. You might be wondering, is that at all realistic? Really hard to say, because Lemonade can be very, very conservative in their guidance, and somehow how they sort of say one. I think they play it really safe and conservative in sort of the official memos, but then they could definitely turn on the heat and beat that. If you go back to the Q3 letter, I was just listening out for a run and just listened to this, not the letter, sorry, the earnings call for Q3, just listen to the call again. Tim did say, I think this was Tim talking, no, Daniel did say, we spoke of 25% compounded annual growth rate at our target growth rate, and we anticipate our growth rates in 2024 will be at or around this target. Continuous and strong growth are key to fully harnessing the benefits of automation. So what does that mean? Okay, so you think, well, maybe they're only doing 25%. And what I'm suggesting here, 44%, is completely out to lunch. Hard to say. Maybe I am too bullish here. Maybe even if you say, yeah, maybe it's 40% or 35%. Maybe that's still way out to lunch. But it's hard to say, because management, they'll say things like this, but then there's other comments like that Riley pointed out in the Synthetic Agents blog, where he talked about, this was tweeted, and I did a retweet of this, and it was really, really great. Just catch by Riley. Give him a follow on Twitter if you're not following him already. And he's only got 23 followers. Give Riley a follow if you're on Twitter and you're following Lemonade. He's got really, really great posts. But it's saying, hey, in their Synthetic Agents blog, it says they're modeling for 12. This holds true in modeling not only for 12 or 20% compound annual growth rate like we showed in November, but for growth in the 30s and 40s too. So it's like, they'd throw in little nuggets like that, like, hey, yeah, this works great if you're modeling for 20% growth rate, or if you're modeling for 30 or 40% growth rate too. So it's hard to say exactly what they're going to do. I'm just looking at, what are the numbers telling us? I'm just trying to look at the math. What is the math telling us? If you look at these equations and you say, hey, they're getting 25 million just off the bat. Hey, they might be spending 80% of what the synthetic agent and their own spend could sort of turn out to. I'm saying, hey, maybe they're getting $120 million per customer they're spending. That might actually be even less than that, because like this last quarter, they only spent $80 some per customer. So it's hard to say whether the number could come in, but debatable even if that's a little bit too conservative. But I'm just trying to show us, here's the math. And here's, based on historically what we know, 2% bundling rate, $325 of premium per customer, coming in the door, the different values I showed here. It works out to, you're getting close to that 1.1 billion in IFP, and north of 40% year-over-year growth is realistically, I think it's realistic. I think it's possible. So we'll obviously have to see what they actually guide for. Now, obviously, nothing in my videos is financial advice, but this is what, at least for me, the math is telling me. Now, if we think about what Lemonade's management might actually guide for, it's really difficult to say with any clarity. Of course, in their last earnings report, they said that maybe 25% rate, but of course, you've seen signs other places, like I showed earlier, that they might step up their growth. And with their rate increases taking effect and rates becoming adequate, you really would expect, why wouldn't they kind of step up the growth? And so my thoughts here, if I find the tweet, is I had tweeted this out before, that, hey, I think they might be around, if I had to guess, I think they push that number a little bit. Maybe they guide for like a 30% in-force premium, which grows to, maybe equates to like a $950, $975 million IFP range at the end of 2024. But then, of course, like I'm showing, I think they easily beat that and land well over $1 billion, maybe even closer to, $1.05 billion or $1.08 billion, like I have here in my model. But that's sort of what, if I had to take a stab at it, obviously can't read their minds, don't know what exactly they're thinking. We'll find out a lot more when they release the earnings. But I think that would be a positive sign even for the market if they give kind of a 30% growth rate, expected growth rate. If it's like 20%, even 25%, it's still like a little bit weaker on the growth side. 25% might be okay, but in that range, I think 30 would signal something much more positive. I don't think they're going to signal more than 30, even though they might actually grow more than 30. But if I had to guess, that's sort of my thought. They might say that 30% number. But the one kind of question mark we have, I think, within all of this is, where might their adjusted EBITDA come in at? And does that even sort of the optics around their adjusted EBITDA come in at? Does that affect what they might actually push their growth levels to in 2024? That I'm not really certain about, and I hope we find a lot more clarity from the call. Because if they're going to grow to 2.7 million customer count by the end of 2024, which is kind of what I got to from that assumption at the start of the video, where I said, hey, 80% of their marketing dollars they could have with the synthetic agent program and their own dollars, say they spend 80% of that. That's kind of where we got to the 2.7 million. And I don't know why they wouldn't do that, because in my mind, if rates are adequate, then and the marketing is, good LTV to CAC you're getting on the marketing you're spending, then why wouldn't you just keep spending those dollars? But if they do that, though, and the result of that is you are growing a lot, and next customers gained is 680,000, as well as the customers that churned away, which is also a really significant amount. So you're gaining a lot, you're spending a lot in your marketing, and because of all that, your adjusted EBITDA, it doesn't look way better. In this case, in 2024, I'm at minus 175 million. So it'd be similar or potentially even slightly worse than 2023. Minus 175 million adjusted EBITDA loss. And how will the market take that? Really not sure. What will be Lemonade's guidance around that? Really not sure. But that's what they're showing there. Now, just to sort of illustrate this, say they grew way less. So say they only grew, let's just say like 2% a quarter. I'll just change it, 2% a quarter. But because maybe their internal, the customers that are there already, more of them bundle, maybe the premium per customer rises faster. So maybe this rises faster, but your customers you're acquiring is a little bit less. You do the math. Pull down all the way down to the bottom here. I mean, now suddenly your adjusted EBITDA is 126 instead of like 175. So a really big difference suddenly, because you're not growing and acquiring nearly the same number of customers. So it's interesting what the balance will be from management of growing, and whether they care about sort of the optics around their adjusted EBITDA, or if that's just going to be sort of a negative loss. And if it is a pretty significant loss, or similar to this year, or sort of only marginal improvement, is how is the market going to see that, understand that? Would be interesting. Now, to show you though, in this scenario still that we model out, and you get down to that $175 million loss, then in 2025 you carry the story forward again. And I haven't modeled this as closely, really had been as precise on some of the numbers, but currently right now, then I have $137 million loss, and really tapering down at the end of the year, and then starting to reach adjusted EBITDA profitability in 2026. So they might still be on track towards that, even if 2024's guidance for adjusted EBITDA doesn't really look that great on the surface. So that it would be a little bit of pause as investors to think about, hey, how will the market perceive that? And another big factor in my model that could be too conservative and does have a big effect on your bottom line adjusted EBITDA is that customer acquisition cost. So right now I have $129 in per customer. If you look back, you can see that the cost of acquisition per customer has really varied, as high as 191, 159 at the very, very highest, 150, 40 range, and has been lower, 98, or even as low as $80 per customer in last quarter. So I put in $129 for this year and then $140 per customer next year. But really the last 3 quarters have been 98, 80, 110. So it's hard to say what that number might be. Maybe that $129 is really way too high, and say they're getting all kinds of renters and pet insurance customers for a really low rate because people tell their friends, hey, get pet insurance from Lemonade. It's the very best, and everyone just word of mouth spreads the word, and so then they get lots of customers for free, and then their overall cost is way less. So say that's 100, then your adjusted EBITDA change went from minus 175 to minus 145. So a huge difference right there. And then say for, next year, same idea, I have 140, but say they continue that growth trend all the way into next year, well then suddenly now next year, or 2025, I'm saying by next year, is now minus 83. So huge, really significant difference in what adjusted EBITDA could be for 2024, 2025, depending kind of what they're acquiring their customers at, and what we assume for those values can be quite sensitive on the overall model. To summarize this whole video, though, there's obviously lots of uncertainty, especially the further out we look for 2024, even 2025. But for Q4, what I'm thinking is somewhere in this range of, maybe around 750 million IFP, 74% loss ratio gets you to that low $30 million adjusted EBITDA loss, 60 some cents earnings per share loss. So if I had to take a guess and the logic I laid out, that's kind of what I'm thinking for Q4. And again, for my model for 2024, I think they're going to end somewhere in that closer to north of $1 billion IFP, maybe $1.080 billion is what I'm modeling right now. And adjusted EBITDA loss, I'm less certain there, minus 175. Could be, I think, even better than that, potentially what their customer acquisition costs are coming in at for the amount of growth that they have, and for the amount of growth they decide to implement, the amount of customers they're trying to try and grab. So that's where I'm seeing things. And if I had to take a guess to summarize again, I'd probably say they're going to shoot for maybe 30% guide on the growth. So those are my summary of my thoughts. Obviously, tons of uncertainty. Really excited for earnings, though. I don't think there's been a Lemonade earnings that I've been this excited for yet. So love to hear any feedback you have below on anything in this video. Let me know now in the comments, or shoot me a message on Twitter. Thank you so much to people that support me on Patreon. You can join them, get full access to the model there. And remember, it's in the bag.